Silicon Valley Bank's failure in March of 2023 kicked off a couple months of banking crisis that was felt around the world. But since it didn't lead to a 2008 style collapse or even a wave of bank failures, everyone assumes that was it, no long run damage done. But that's not the case. In fact, we see evidence all over the place that shows the aftermath of Silicon Valley Bank is still with us right now, troubling the banking sector, the financial sector, the monetary system, and especially the real economy. This is a case where the Federal Reserve appears to have won the battle, yet lost the war. And the evidence is clear and unambiguous too. There is no gray area. This is beyond every shadow of a doubt. From the markets around the world to the behavior of banks following the multiple failures in March 2023. Remember, it wasn't just SVB and Signature. Everyone forgets Credit Suisse because Credit Suisse doesn't fit into the narrative of overextended U.S. regional banks that were suffering interest rate-induced deposit flight. Now, while there's more to the story of those failures and the actual bank crisis itself, we're going to be concerned here with its still unfolding aftermath because there is one. One where the economic costs are continuing to pile up month after month, quarter after quarter, year after year. The world that forgot how to grow didn't actually forget. It was robbed of its vitality in this transition phase following the supply shock price illusion, the one we're still in, which is causing GDP to stagnate all around the world and labor markets to do no better. And that transition phase was punctuated by two major global monetary and banking events. September 2022, which was called a gilt crisis that had a lot less to do with the UK, and then the banking crisis in March of 2023. It was a clear as day 1-2 punch that cemented the whole course the world has been following ever since. These sideways trends that have emerged all over the planet, even the American labor market, all of them trace back to that 1-2 crisis strike. Now, Jay Powell appeared to have won the battle over regional banks, but then he lost the war on the real economy. He just doesn't know it yet. His counterparts around the rest of the globe are beginning to realize this, or at least acknowledge the symptoms as this aftermath of the 2023 banking crisis can no longer be so easily ignored. The evidence is unequivocal. For example, Germany's 2-year bond, its yield hit its cycle high March 9th of 2023, the day before Silicon Valley Bank. It has been going lower ever since then, even though central bank rates continue to go higher for quite some period of time thereafter. But now central bank rates are coming down too. So let's get this out of the way first. Everyone's going to say that everything that's happened in the global economy over the last couple of years, including the banking sector, and even the markets, even though the markets show otherwise, it's all about the Fed, the ECB, and central bank rate hikes. If the economy is slowing down, if the economy is going sideways, as we see all over the world, then that must be because Jay Powell and Christine Lagarde have been raising rates. But all of this stuff happened before rates, assuming rate hikes actually do what they're supposed to do, assuming that you believe that, they wouldn't have been able to have an immediate impact like we see in September and October 2022 or in March of 2023. As economists and policymakers always say, rate hikes work with long and variable lags. These events happened while rate hikes were still unfolding, still in their earliest phases. So everything changed in the real economy, the banking system, and the marketplace before rate hikes would have had any impact, assuming they have one at all. We see this all over the data. For example, just in consumer price rates. Consumer price rates changed their trend, the inflection, middle of 2022. And it was that inflection in not just consumer price rates, but what that represented for the overall economy, which created the conditions that became these violent monetary and financial transitions late 2022 into early 2023. And so the crisis that was labeled as a gilt crisis in September 2022 was really the consequences of this transition and transformation. The realization dawning across the marketplace and the real economy by a few at first and then more as it continued to go on, that this was not a sustainable recovery, that it was a product of massive distortions and imbalances that were going to lead to disorder, decay, and degradation. You can't just impoverish the entire world and expect it to work out fine. The realization of that fact dawned on the marketplace much sooner than everywhere else. And to begin with, policy rates were not all that high. Yes, they were moving up quickly, but by September 2022, the ECB's MRO, which is the midpoint, which used to be their policy emphasis, was only at 1.25% when all of this really got started. The Federal Reserve had moved up their federal funds range, and the RRP is the quasi-floor for it, to 3%. So rates were relatively low, and yes, they were moving higher quickly. Again, long and variable lags. Even central bankers will tell you their rate hikes don't work immediately. So how can we have all of this chaos in the marketplace, as well as the real economy and the banking sector, if rate hikes work on long and variable lags? They're not that variable. In fact, they don't work at all. Instead, what we see in all of this evidence, that the sideways GDP, sideways labor market that starts to show up, especially in Europe in the fourth quarter of 2022, before rate hikes would have had a chance to do something like that. European bonds and European lending, late 2022. It was the 1-2 punch of September 2022 and March of 2023. And this is something that we've covered in Eurodollar University's deep dive analysis, this along with many other topics, where we marry the analysis of the bond market, interest rate curves, and a whole bunch of other indications that tell us what the system itself is thinking in real time, but also the perspective of the Eurodollar system and how that plays into macroeconomic circumstances. So check out Eurodollar University's deep dive analysis, as well as our daily briefing and especially the memberships which go over the background. What is the Eurodollar? What is money? What is QE? What is the Fed? All of these questions are answered. Eurodollar University subscriptions, the deep dive analysis, the daily briefing, and the memberships. Check them all out at our website, eurodollar.university. The best way to illustrate what I'm talking about here is to use the German 2-year bond. The reason why we're looking at the 2-year, and we pay a lot of attention to the 2-year, not just in Germany, but also in U.S. Treasuries, is because that's that spot on the yield curve where there is some degree of balance between the front end, which is heavily influenced by central banks and their policies, and the longer-term interest rates and longer-term securities, which are heavily influenced by fundamental factors, growth and inflation expectations, safety considerations. So you have that spot where those two sometimes competing forces actually combine. And so the 2-year is influenced by both of those, usually in some kind of balance. It's when those forces, potentially opposing forces, get out of balance that you really pay attention to what's happening on that spot on the yield curve. And we saw that in 2022. The balance shifted towards central banks as central banks began to more aggressively hike their interest rates. And you can see very clearly here, the 2-year German had followed the ECB and actually had moved in anticipation of the ECB up until October of 2022. Then in September and October, we saw the German curve invert in certain parts of it for the first time ever. And then that inversion went absolutely crazy during this September 2022, October 2022. Really, it was a collateral crisis. That's why you had banks going to the Swiss National Bank and bidding for US dollar funding auction. It wasn't about the UK gilts. It was about the market, the monetary system's reaction to what was unfolding at that time. And I don't mean rate hikes. So curves absolutely went crazy. And this is the time when you see economies all over the system start to fall off and go into their sideways trend. But as far as the German 2-year is concerned, between October 2022 and March 2023, until the day before Silicon Valley Bank failed, the 2-year German still followed the ECB, but with a smaller spread. It was more hugging the ECB rather than anticipating it. There's clearly some doubts showing up in the marketplace. And then March 9th of 2023, that is the ultimate cycle high for Germany's critical 2-year maturity. The day after, March 10th, is when we learned Silicon Valley Bank had failed. And ever since then, ever since March 9th, Germany's 2-year yield has been moving sideways to lower. That specific day was very clearly the trend change. And look how everything had changed. The whole market had shifted. Even longer-term German rates, and as we'll see, treasuries too, they had already started to invert to the ECB's policy rates after October. But once the twos began to openly defy the central bank, it was all bets were off. Whereas the ECB, quite importantly, kept on going higher. From that point on, March 10th of 2023, Germany's 2-year started to ignore and completely ignore what the ECB was doing. So it went from hyper focused on central bank policies to less focused to suddenly not caring one bit what Christine Lagarde was up to. In fact, the ECB conducted 5 more rate hikes, 5 of them, including a 50 basis point hike just days after Credit Suisse failed in March of 2023. So the ECB added another 150 basis points to its rates. The 2-year didn't budge. So while the 2-year would come close to that March peak by September, it was really all downhill from there, going all the way back to September 2022, and really the point of emphasis, March 9th and March 10th of 2023. And now, of course, central banks are following what the market had laid out back then. And what it all simply means is that the market started to sense the transition from the artificial, distortive supply shock price illusion was not going to go smoothly, because it wasn't going smoothly. Those distortions were just really too big to settle into some stable long-run trajectory. And that's the very reason why Silicon Valley Bank and Credit Suisse, to an extent, had failed to begin with. Silicon Valley Bank in particular had fundamentally misread the economy of 2021. They were extending loans to risky companies that ate through its cash pile, which they all mistook in 2021 as a sustainable recovery. Now, there's more to the crisis than just that, but the story fits within this ultimate trajectory. The marketplace realized 2022 was getting very serious, and by the bank crisis in 2023, the transition was going to be messy, and it was going to end up nowhere good. In terms of U.S. Treasuries, much the same story. Again, we'll focus here on the 2-year. The Treasury 2-year had reacted even more forcefully to October of 2022. Again, it followed the Federal Reserve and rate hikes. In fact, it anticipated the Federal Reserve and rate hikes. But once we get to October 2022, things really started to change. The 2-year fell under the reverse repo rate by December of 2022. Then it popped higher in February 2023 as everybody was talking about no landing scenarios, things looking like the economy is going to hold up in the U.S. But then once SVB failed, March 10th shows up yet again. Now, while the U.S. Treasury 2-year would surpass that peak from March 9th by September, it was only by a few basis points. And just like the German 2-year, as you can see here, the U.S. Treasury 2-year has been sideways to lower ever since, regardless of what the Federal Reserve has done in between, or what the Federal Reserve said it was going to do. Because remember, by September and October of 2023, the Fed was talking about going even higher and keeping rates up for a lot longer. Instead, 2-year Treasuries, 2-year Germans, they start to go down even more aggressively than they had been since Silicon Valley Bank failed. So as far as the marketplace was concerned, SVB was the final nail in the coffin. The Fed seemed to have won the battle in terms of maintaining banks and not allowing for a wave of failures, but lost the war, at least according to the marketplace and all of the evidence that continues to pile up from all corners of the globe. But it's not just bond markets and interest rates. We can see the same thing in the behavior of the banking system. I've talked about Europe. In fact, I went over Europe in just a recent video. Let's talk about here the U.S. banking system and how we can clearly see Silicon Valley Bank as that moment, that final moment which changed everything. So we'll start with bank credit. And bank credit just simply means it's everything that a bank has in terms of its lending activities. So bank credit is basically everything related to the activities we associate with the bank. And total U.S. bank credit, it hit a wall very clearly August into September of 2022. Again, long before rate hikes would have had any negative impact on either the real economy or the banking sector. And it only picked up slightly, bank credit, in November and December of 2022 until the week of March 8th, 2023. And what happens March 8th and then March 9th and 10th? Bank credit drops off sharply over the next 2 weeks during that regional crisis. But it wasn't just a 2-week thing. You can see that there was a very clear change in the behavior of bank credit. And while it did restart again in November of 2023, that was not lending. Banks didn't start lending again after a few months in the aftermath of Silicon Valley Bank. Instead, what they did starting November 2023 is pile on more safety and liquidity. That rise in bank credit is nearly entirely government bonds and agency debt. In fact, more recently, it's less mortgage bonds and almost exclusively government, U.S. Treasuries, and agency securities. When we look at loans, look specifically loans, what you see is that clear inflection, Silicon Valley Bank, and an inflection that remains to this day. Silicon Valley Bank was the last marker in that transition process that said this was going to be a permanent shift. And that shift in lending was even more pronounced, as I went over in a video last week, when you exclude loans to investment funds, to the financial economy, or certain parts of the financial economy. So regardless, banks have become a lot more defensive, not less defensive, buying record amounts of government bonds ever since SVB. They stopped lending, especially to the real economy, no matter what the Federal Reserve has done. They have followed interest rates going sideways to lower, which should mean more demand for borrowing, but instead it has meant defensive behavior, risk aversion. Banks realized, as the entire bond market realized, Silicon Valley Bank, the bank crisis, was not a one-off. It was a symptom of a much bigger problem. And it's got to the point where bank lending in the United States is at crisis proportions. You don't think so because it's nothing worse than sideways. But sideways, as I keep pointing out, is the equivalent of, in this case, lending death or economic death when we see it in GDP. It is slowly strangling a real economy that is already dealing with more headwinds than it can really handle. So it adds even more negatives, this credit crunch, to this same transitions. The more defensive banks become, the more the transition becomes problematic. And we see this again in markets as well as economic data all over the world, including the US and the labor market. Where did the labor market transition in the US? The unemployment rate hit its low April of 2023. It started to rise in May, just after the same transition I'm talking about. So it wasn't just banks, it wasn't just bonds, there was real economy fallout that we're still living with now to what happened in March of 2023. I mean, after all, what are lower interest rates? Now, you're taught that lower interest rates are stimulus and that they're directed by central bank policies, but no. When the 2-year begins to rebalance toward the long end fundamentals, it means lower growth and inflation expectations. What have we seen since all of this started to happen in 2022 and the banking crisis in 2023? Lower growth and less inflation, or what people call inflation. And the markets are saying that we are not done in this transition, this aftermath from SVB. Lower growth, zero inflation. And why would markets begin to rethink growth and inflation expectations after a monetary crisis and all the economic difficulties which strongly emerged between September 2022 and March of 2023? Well, the question answers itself. According to the banking system itself, this was not going to be a smooth, peaceful transition between the supply shock, the artificial price illusion, and the long-run fundamentals. You can't just impoverish the entire world and expect it's all going to go just fine. The imbalances of that price illusion, the distortions were just way too much, and Silicon Valley Bank's failure, along with the others, including Credit Suisse, importantly, it wasn't just U.S. regional banks, that was the final touch proving this transition was not going to go smoothly. So the crisis itself wasn't about so much a crash and a wave of bank failures as it was to the marketplace and to the banking sector, proving the difficulties that we're going to be facing for the long run after the experience of the pandemic in the 2020s. So while the Fed may have won the short-run battle on that banking crisis, the evidence continues to show, not just strongly, but unequivocally, they lost the war. But it's not really the Fed's war to lose. It's really the impoverishment of this period we've all lost. This unnatural sideways trend, we see it all over the place. We see it in Mexico, see it most prominently in Europe. I went over that in the video link below. As always, thank you very much for joining me. Huge thank you, Eurodollar University members and subscribers. And if you want to become one, check out our website, eurodollar.university. And until next time, take care.